Okay, this is going to be an overview of the stock market here and investing in stocks, and we'll look at some specifics about that. So we will get going here with our Prezi. And it looks kind of nice, if I don't say so myself. Okay, so first off, when you buy stock, what actually are you buying? Well, you are buying ownership in a company. Okay, the more shares you own, the higher your ownership percentage. So, you see the certificate of Facebook there. If you own 100 shares of Facebook, that's 100 shares out of about 100 million. So you're not a very influential owner. You don't own a lot of the company, but you do own something. Okay, so you are buying ownership of the company. So you get a piece of everything Facebook owns. So you are, again, buying ownership. And with that, you also get one vote for each share you have. Companies have to elect a board of directors, which are people on the outside. They're not employed by the company, but they look out for shareholders' best interests. And one of the main things they do is hire the CEO, or the person in charge of the company. So if shareholders don't like what's going on, the board of directors can replace the CEO. All right, so it's kind of like how the school board for District 211 looks over the school district. They're not school employees, they're elected by citizens that live in, our District 211 boundaries. So it's for every one share you have, you get one vote for that board of directors. Okay. Now, how much you pay for the stock? And this is, what we're in it for. So what controls the price? How do we know what it's worth? Well, it's mainly controlled by simply supply and demand that we've talked about in class before. Okay, if people really like a stock and people are buying it and buying it and buying it, there's a high demand, then the price is going to go up. Okay, because supply is going down because people are buying it. On the flip side, if everybody's selling a stock and sell because they, for whatever reason, they don't want it anymore, then supply is going way up and demand is going way down. So the price would go way down. Okay, so it's just simply supply and demand. Now, what controls that supply and demand comes into play. So public opinion is one piece. Okay, what people think of the company, the success of the company, whether they like the company. All right, news articles that come out about the company, what they're doing, how well they're doing. It could be bad public relations. An officer of the company gets arrested for something totally unrelated to the business, but it's out there. It influences public opinion, which might cause somebody to say, I don't want that stock anymore. It's too risky. I'm getting rid of it. Okay, well, and then also the success of the company. It somewhat controls the stock price. If a company does well, they make money, they're growing, the stock price reflects that. On the flip side, if a company is losing money, they're struggling for whatever reason, the stock price is going to reflect that also. Okay, so a lot of times that public opinion and that supply and demand is determined by the success of a company, but not always. Okay, a true story, when Yahoo first was created, if you guys probably can't even remember such a thing, they lost money like crazy. Yahoo lost money unbelievably, but people saw the potential in the future, so they bought the stock anyway. So there was a high demand even though the company was losing money because they were buying it for future potential. So the stock price went up. Okay, so that's a little bit how the price is determined. So then, how do you make money from your stock? And we have, first off, a capital gain. So a capital gain is when you buy a stock for a certain price and then you sell it in the future for a higher price. So it's just like anything else. We buy a stock for 20 bucks a share, you sell it for $25 a share. You've just made a capital gain of $5 per share. Okay, so it's selling it for more than you bought it. Unfortunately, the flip side can also happen. If you sell a stock for less than you bought it, you now have a capital loss. So you've lost money. Since we know that making money isn't guaranteed. Okay, we do have risk. Okay, here's something that's new, dividend income. Okay, what a dividend is. Certain companies, not all, if they do really well and they make a profit, meaning there's money left over when all the bills have been paid, they can choose to share that profit with their shareholders, with their stockholders. So they have money left over and they can divide it up and send it out to all the people that own stock. So if you have 1,000 shares of Apple and Apple decides to give a $1 dividend per share, you would get a check in the mail for $1,000 for doing nothing. Just because you own the company, they did really well, and they decided to share it with shareholders. It's not mandatory. They don't have to do that. Companies do that to encourage people to invest with them and to reward their shareholders, but it's not mandatory. Okay, so you can make money through dividends in that regard. Okay, so let's talk about a little about which stock to choose. And we're going to talk about two different categories of stock. You may have heard this term before when they talk about blue chip stock, and that comes from the poker world, where blue chips normally are the most valuable chips in a poker game. So blue chip stocks are those companies that have a long track record of success. They've been around for a long time. They consistently pay a dividend, which we just talked about. Okay, so they share their profit with shareholders, and you would invest in these types of companies looking for long-term growth. Okay, Pepsi is not going to triple in price overnight. Okay, Pepsi is Pepsi. They've always done the same thing, and they inch along, and they grow, and people are going to buy Pepsi. But they're not going to be the next Apple that revolutionizes our economy. Okay, but long-term, great company, and not as much risk there. On the flip side, we have stocks that we will call growth stocks. So these are new companies still looking to grow. Okay, so we have like Pandora there. It's pretty new. They're still looking to grow. They don't have a real track record yet. They reinvest any profit they would make. Okay, so you're not going to get a dividend from this type of company because any profit they make, they want to reinvest it in the company and hire more employees, expand, hire better employees, research new technology, things like that. These companies' stock price tends to grow pretty quick, though, if they're successful. All right, so even though you're not going to get a dividend, the share price will go up faster than a blue chip stock because they're growing. Remember, Pepsi's Pepsi. They sell beverages. That's it. Okay, who knows what Pandora could do next? You never know. Okay, but with growth stocks, you have a lot of risk. Okay, Pandora, you may think that they're going to be around forever, but who knows? I mentioned Netflix in class. Yeah, they've done well for 3 years, but Pepsi's been around for 30 years. And I don't, Netflix, I already gave you my opinion. I don't think they're going to be around long unless they change their business strategy. So that would also be considered a growth stock. So we have blue chips and growth stocks. All right, so next we're going to look at a little video about minimizing the risk that you have to take. Okay, and it's going to talk about diversification and something called mutual funds, which we'll talk specifically about at a later date, but we'll watch this video to wrap it up.
Did you know that a share of Google, which sold for $506 in 2011, could have been bought in 2004 for about $100? Apple, selling at $336 mid-year in 2011, could have been bought for $3.02 in 1984. And what about Microsoft? Selling at $26 on June 30, 2011, Microsoft could have been bought, adjusted for stock splits, in 1986 for 8 cents. Make a few investments like these in your 401k, and you could retire early. But don't give your notice quite yet. For every technology company that made it big, there are a dozen that failed, and the risks don't stay with just technology companies. How about Enron, one of the nation's largest energy companies, at one time? Its stock went from $90 in August 2000 to under $1 in 15 months. Ford Motor, its value has been cut in half over the last 10 years. How about Chrysler, or AIG, Bear Stearns? The possibility of losing lots of money by investing in stocks is what we refer to as market risk. Investing in a stock can also involve another form of risk, company-specific risk. You may have thought correctly that it was time to invest in technology stocks, but you picked a company whose operations, or product, or business environment caused it to underperform other companies in the same industry. Its business failures and poor stock valuations had nothing to do with the overall economy. Foolishly, some people have invested a very large percentage of their portfolio in just one or two companies that failed spectacularly. Obviously, they never took to heart the general principle of never putting all of your eggs in one basket. Well-diversified stock portfolios avoid company-specific risk, and long-term, they can reward you for the market risk you take. Diversification means that you own a wide range of different types of stocks, easily categorized as companies here in the US or overseas, and by capitalization, meaning how big they are. Unless you have the expertise to undertake the research into individual stocks, we suggest you invest within a mutual fund. Mutual funds offer you the opportunity to diversify your portfolio and minimize company-specific risk. Keep in mind a few facts about investing in stocks. It should not be a surprise to you that the stock markets go down as well as up in value. The surprise is when stocks go down, and by how much. Don't panic when the market goes down. You make money in the stock market because of the risk, not despite the risk. Some stock investments will do better than others, but performance will often zig and sag. It's impossible to always know with certainty in advance which stocks will perform better than others. We think the secret to investment success does not require you to know in advance when the market goes up and down. Success comes from owning a well-diversified portfolio, one whose risk is right for you and your circumstances, and one that you can own long-term through the inevitable ups and downs of the financial markets.